Hello and welcome to another episode of Decoding IPOs by the Financial Investment Cell of Kirori College. Today we'll be discussing about the IPO of Aegis Vopak Terminals Limited. Now talking about the company, it was incorporated in 2013 and is India's largest third-party owner and operator of tank storage terminals for LPG and liquid products in terms of storage capacity. They provide safe storage for petroleum, vegetable oils, lubricants, chemicals and gases. They own approximately 1.5 million cubic meters for liquid products. They have 16 liquid storage terminals located across India and 2 LPG storage terminals. Now, talking about the oil and gas storage industry in India, there has been a growing energy demand following urbanization and rising vehicle ownership. There has been infrastructure expansion. The oil and gas storage market in India is projected to grow. The total allocation that has been received by the Ministry of Petroleum and Natural Gas is 1.19 lakh crore for fiscal year 2025. The demand growth is expected to account for more than one third of global oil demand growth through 2030. The Oil Fields Regulation and Development Amendment Bill aims to encourage private investment in oil exploration and reduce import dependency. Now, talking about the details of the IPO is currently open. It has opened on 26th of May and is supposed to close on the 28th. The tentative date for allotment is 29th of May. The initiation of refunds and the credit of shares would be done on 30th. The tentative listing day is 2nd of June. The face value per share is 10 rupees. The price band is 223 to 235. The lot size is 63 shares. The total issue is about 11 crore shares. All of them is fresh issue. None of it is offer for sale. All the proceeds go towards the company. The minimum investment for it is 14,805 rupees. Now let's talk about the financials of the company. The revenue from operations has seen a growth of 60% from the previous year. The EBITDA margin is approximately 40.6%. The earnings per share pre-IPO are 0.88 and the post-IPO are 0.91. Now let's talk about the liquidity. The company is pretty liquid. It has a good current ratio of 1.36, which has improved from the previous year. The company has good cash and cash equivalents. The company is seeing good increase in current assets. Now coming to the capital structure and solvency, the borrowings have heavily increased from the previous year. The liabilities have also increased. The equity, however, hasn't increased that much. That's why the debt to equity ratio has increased significantly. The assets and the liabilities both have increased, causing high increase in borrowings. Now let's talk about the cash flow position. The cash flow from operating activities has seen a strong growth. The cash flow from investing activities shows that there has been a lot of capital expenditure and acquisitions. Cash flow from financing activities shows that it has borrowed heavily. The net increase in cash has also seen a significant rise. Now let's talk about the key financial ratios. The EBITDA margin 40.6%, the net profit margin 15.4%, the return on equity is 8.7%, the debt to equity 2.59x, the current ratio 1.36x. These financials indicate strong position in the market. These financials indicate strong profitability. However, the P ratio, that is pre-IPO 268 and post-IPO of 259, show that the company is pretty overvalued. The stock is pretty overvalued for its financials. Now let's talk about the GMP. The GMP for Aegis Vopak is 5%, which is extremely low and shows pretty low investor confidence. The GMP has been decreasing over the days of the IPO, which is not a good signal for the IPO. Now talking about the objectives of the offer, major portion of the proceeds will go towards the repayment of particular borrowings that have been availed by the company, and certain parts are also allocated towards the funding of capital expenditure towards contracted acquisition of the cryogenic LPG terminal at Bangalore. Now let's talk about the strength and risks of the company. The company has a track record of consistently expanding capabilities and well storage equipment infrastructure. It has relationships with diverse customer base covering various industries. The company is backed by established promoters and supported by a strong management team. However, the risks are that they heavily rely on top 10 customers for revenue. They operate as a joint venture between Aegis Logistics and Vopak India, which may have conflicts in decision making. With most terminals in India's west coast, adverse regional developments could affect the business financial condition. Now, talking about the subscription rate, as of 27 May, the qualified institutional buyers have subscribed about 0.39x. The non-institutional investor quota has about 0.08x subscription. The retail individual investor quota has about 0.37x subscription, which brings a total of 0.3x subscription, which is extremely low, and it faces a risk of being undersubscribed and being cancelled if it remains under 0.9x. However, there is a possibility that the underwriters may book the IPO. However, it will not affect the grey market price. Now, for the verdict, the company has strong financials with a recent increase in borrowings. However, at a PE of 260 to 270x, Aegis Vopak is priced at a very high earnings multiple relative to established energy logistics like IOC and others that are trading at 8x to 30x. The GMP has been in a downward trend in the first 2 days of subscription, indicating low investor confidence in the IPO. Significant portions of proceeds will repay debt, and only a small portion will be used for capital expenditure. Being a 50-50 joint venture, promoter conflicts can affect strategic decisions. Investors with long-term view may apply, seeking exposure to critical energy infrastructure. Short to medium investor focused on valuation may not apply and find the IPO richly priced with growth risk.